This accounting mini lecture covers statement of cash flow classification. When we are classifying activities and transactions for the statement of cash flows, we have three categories of activities. We have operating activities, investing activities, and financing activities. No matter the size of the business or the industry, these are the three categories that we will always see on the statement of cash flows. Okay, let's start with operating activities. Operating activities are basically the core business activities. These are the activities directly associated with whatever the company is in business to do. Some of the most common cash inflows that we're going to see in the operating section is going to be related to sales. We're also going to see changes related to accounts receivable, inventories, accounts payable. These are all areas that are directly related to a company's core operations. Now, you'll also notice that in the operating section, we also include interest received and interest paid. These are classified as operating activities rather than financing activities, so it's important to note that. Also, one other thing that is noteworthy is that if a company receives dividends, if we receive dividends from an investment, we classify that as an operating activity. Okay, as we're going to see in just a moment, if we pay dividends, it goes in another area. But if we receive dividends, that is considered an operating activity. Now, investing activities are basically activities that include not only what we might typically think of as investments, such as, purchasing the debt and equity securities of another company, such as our trading securities, our available for sale securities. Those are investing activities, but investing activities can also include changes in our long-term asset accounts, such as our property, plant, and equipment. If we purchase or sell property, plant, and equipment, that is considered to be an investing activity. Okay. Financing activities. These are basically the activities that help to fund and finance the business outside of just the funds that we get in operations. We have two basic ways to finance a business, and that is through either debt, such as loans or notes or bonds payable, things of that nature. And then, of course, we have equity. So that's going to include any transactions occurring in common stock, additional paid-in capital, treasury stock transactions. And interestingly, if we pay dividends to shareholders, this is where we will report that. Remember when we were looking at the operating activities, we noted that if we receive dividends, that's considered an operating activity. Well, if we pay dividends to our shareholders, that is considered a financing activity because those dividends are being paid based on the equity financing. Now, some companies will also have significant non-cash investing and financing activities. And generally, if they do have these types of transactions, these will either be reported on the face of the statement of cash flows, or it will be disclosed in the financial statement footnotes that directly follow the consolidated financial statements. But here we have some real simple examples of something that might constitute a significant non-cash investing and financing activity. Retirement of debt using stock, conversion of preferred stock to common stock, lease of assets in a capital lease transaction, purchasing long-term assets with a note or a bond, or exchange of non-cash assets, purchase of non-cash assets using equity or debt. Now, again, it would need to be, a significant transaction in order to be reported. But oftentimes, these types of transactions would be material from a financial reporting perspective. Thank you for watching this video on the Statement of Cash Flow Classifications.